A woman in her early 70s had been married for more than 30 years when her husband passed away. She did everything she thought she was supposed to do. She called Social Security. She handled the funeral. She notified the bank. 9 months later, a letter arrived from the Internal Revenue Service. She did not owe any taxes at all. She had missed one filing deadline she never knew existed in the first place. Because she missed it, a tax protection worth millions of dollars was permanently gone forever. Nobody at the hospital told her. Nobody at the funeral home told her. Nobody at the bank mentioned a single word about it either. Today I'm going to make sure nobody can ever say that about you or your family. The day your spouse dies, the Internal Revenue Service starts a 9-month clock ticking. That is not a guideline or a suggestion you can safely ignore for a while. According to official IRS instructions, Form 706 is due exactly 9 months after the date of death. The clock runs whether you owe estate tax or not. You can file Form 4768 before the deadline to get 6 more months. That buys you time to prepare, but it does not buy you permanent safety from the rules. So what is actually at stake here? Let me show you with real numbers you can feel. Imagine you and your spouse bought your home decades ago for $200,000 together. Today that same home is worth $1.2 million on the open market. That is a huge gain built up over many years of ownership and patience. Here is where something called stepped-up basis changes everything for a surviving spouse. According to Fidelity and the Tax Policy Center, stepped-up basis resets the cost of the asset to its fair market value on the date of death. That reset can wipe out capital gains tax on decades of appreciation you never actually sold. Without that reset, selling the home could trigger a massive taxable gain overnight. With it, your taxable gain could drop close to zero if you sell soon after. Let me give you an even sharper example using confirmed tax rates. Say the taxable gain comes out to $330,000 after all adjustments. At a 15% long-term capital gains rate, that is roughly $50,000 owed in federal tax. With stepped-up basis applied correctly, that bill could shrink dramatically or disappear almost entirely. To lock that protection in, you need a formal date of death appraisal documented properly. Ask yourself this simple question right now. If a small piece of paper could save your family $50,000, would you get it done this month? Now let me tell you about the form most surviving spouses never file with the government. This is where the widow in our opening story lost everything she did not know she had. Form 706 is how you preserve your late spouse's unused estate tax exemption forever. In 2026, that federal exemption is $15 million per person, according to Morgan Lewis and Citizens Bank. Some older articles online still quote the 2025 number of $13.99 million. The actual law in effect right now sets the number at $15 million per individual. You might be thinking, my estate is nowhere near $15 million, so why would I ever file a federal estate tax return at all? Here's the answer most people never hear from anyone around them. Filing Form 706 is how you claim portability of your spouse's unused exemption amount. Skip that filing, and your spouse's exemption could vanish from your family's future planning options forever. There is some relief available, and honesty matters here more than drama. Under Revenue Procedure 2022-32, estates not otherwise required to file can elect portability up to 5 years after death. That relief requires a complete, properly prepared return and usually professional help to get right. It is not automatic, and it is not guaranteed beyond that 5-year window at all. So yes, a safety net exists, but the net has holes and costs real money. Filing on time with a qualified CPA is still the cleaner path for most families. Before we get to the next step, there is a threat most advice videos leave out entirely. The federal exemption is huge, but your state may have its own much smaller threshold. This is the trap that catches middle-class homeowners who assumed they were completely safe. Massachusetts, for example, taxes estates valued over $2 million, according to the Massachusetts Heritage Law Center. Some older sources still repeat the outdated $1 million Massachusetts number from years ago. Other states have their own separate thresholds, rules, and deadlines you need to check carefully. Pennsylvania has its own inheritance tax system with different rates for different relationships. According to Pennsylvania tax attorneys, lineal descendants like children pay 4.5% on inherited assets. Siblings pay 12%, and other beneficiaries pay 15% under current state law. Surviving spouses in Pennsylvania are fully exempt and pay 0% on what they inherit. So if you live in Pennsylvania, the spouse is safe, but your kids may not be later. That is why checking your specific state rules matters just as much as federal ones. Here's a step almost nobody talks about, and it has nothing to do with your house. Beneficiary designations on retirement accounts and life insurance override whatever your will says on paper. If your spouse named a sibling or a former partner decades ago, that name still controls the money today. According to reporting on a Fidelity survey, over 40% of Americans have never updated their beneficiary forms. That includes people who went through marriage, divorce, new children, and the death of a spouse. A single outdated form can redirect a retirement account away from the surviving spouse entirely. This step costs you nothing at all except a few phone calls to each financial institution. Ask every bank, brokerage, and insurance company for a full beneficiary review in writing. There is one more step that surprises people because it actually puts money back in your pocket. Most states offer property tax exemptions or assessment freezes for surviving spouses who qualify. Florida, for instance, offers additional homestead protections for surviving spouses under state law. Those protections can include the right to keep the homestead exemption on property taxes every year. The exact dollar savings vary a lot from state to state and even county to county. But many of these exemptions have annual deadlines, and missing one year means losing that year's savings completely. The application usually costs nothing at all and is handled by your county assessor's office directly. There is also one more piece of paperwork people delay for years after losing a spouse. Updating the deed on your home to reflect sole ownership is required in most states by law. Filing fees are usually quite small, but skipping this step can complicate future sales and refinancing badly. So here's where all of this lands for you today as a planner and a protector. If you know someone who just lost a spouse or whose spouse is seriously ill, send them this video right now. Not next week, not next month, because the 9-month clock may already be running somewhere. That single share could save their family tens of thousands of dollars in avoidable taxes and fees. If this kind of breakdown helps you, hit subscribe and turn on the notification bell below this video. I break down real tax and estate rules that hit real families every single week here. And drop a comment below telling me this. Did anyone ever warn you about these deadlines, and what do you wish you had known earlier in life? One last honest note before you go, because this matters for how you use what you learned. Nothing here is personal legal or tax advice for your specific situation or family circumstances. Laws change, states differ, and every family has details that need a real professional set of eyes. Talk to a qualified CPA or estate attorney about your plan before you act on anything. The 9-month clock is real, the rules are real, and the money at stake is very real. But knowing about the clock is the first and most important step toward actually beating it.